Welcome back to the Ticks and Trades channel. My name is Sam and I trade the E-mini futures. It's time for another weekly recap. We're covering Monday, March the 2nd through Friday, March the 6th. Everything to the right of this vertical line is this week that we're covering. This is where we discuss what the S&P 500 did since the last weekly recap video, and we look at where potential moves could be in the near to midterm. We use the SPY ETF, also known as the Spiders, which is a proxy for the S&P 500. That's the chart you're looking at now, a daily chart of the SPY. And if you're already trading using the Ticks and Trades strategy and rules, you know that we use levels of support and resistance in the SPY to trade against in the E-minis, which is the symbol ES. It was another week with a lot of back and forth in the same range that we've been talking about. The bulls trying to get up to the former highs, trying to bust through, maybe targeting 700, but failing each time. They've been making lower highs for over a month by now. There are a few things of interest that happened this week that we have not seen in a while. One is that price in the SPY finally got deep into that zone that we've been looking at between 675 and 672. I'll click on the bottom of the zone so you can see that that's the range there. That is the first thing we need to take notice of. And the other thing is that over on the weekly chart, the bulls gave up the 20-period moving average. That is this orange upsloping line right here. The weekly close was decisively below that indicator. The market has been so bullish that they've only managed to tag the 20-period moving average here on this weekly chart just a few times since May or so of 2025. But there have been no weekly closes below until now. That doesn't necessarily mean too much in the overall big picture to have one weekly close below the 20-period moving average. Where the big picture trend could change from bullish to bearish, at least from the weekly chart perspective, is that if price got below the 50-period moving average, the blue upsloping line here. And if they start closing multiple weekly candles below that line in the sand, well, that kind of price action could mean the overall trend has shifted and the bears would have a better chance of pulling price down more for a longer period of time. But price is still very much above that 50-period moving average, which currently is around 638.95. The reason I think this is important is that while we've been seeing several bearish signals emerge on the daily chart of the SPY for the past month or so, the bulls seem to be losing strength, as indicated what the daily chart looks like, and this is the first time the weekly chart has thrown out a possible clue that the bulls may be dropping the ball. It's still too early to know. Again, where would price need to be on this weekly chart before we start talking about a bear market? The first door would be getting weekly closes below, call it 635 or so, below this 50-period moving average. And even then, where would that put price on the monthly chart? 635 is still above the 20-period moving average on the monthly chart, which does not mean very much here on the monthly chart. But if anything of this big picture bearish scenario is going to play out, the point is it starts on the shorter time frames, and that kind of similar behavior makes its way to the longer time frames. So let's take this 4-hour chart, for example. Let me zoom out a little bit here. What have we been seeing on this chart starting around the end of January? Call it right here. We've had a series of big down candles that are trying to reverse this bull trend. It's been a bull trend for a long time. Yes, price has climbed back to the top of each of these breakdown candles for the most part, but they keep getting rejected, making it harder for the bulls to break out and get to 700. So 700 still could be a long-term possibility. It's just that now with the last month's worth of these lower highs and all these bearish signals here, and prices getting under important moving averages on more and more time frames, the bulls will just have a harder time fighting through all this mess. As we all know, anything is possible, but taking what we have in front of us right now, we're seeing more bears come out and more selling lately. The point of looking at this 4-hour chart is that all the bearish signals here have led to a few bearish signals on the daily chart. And then just this past Friday, we have a possible bearish signal on the weekly chart when they gave up the 20-period moving average, closed below it. So things are starting to add up. By the way, while we're here on this 4-hour chart, let's look at a bearish consolidation pattern that did not play out, and the clue that told you that it probably was not going to work out. We'll zoom out a little farther. Back here at the end of last October, 2025, price got to an all-time high at the time and started to pull back. So this pattern setup that I'm looking at starts with this down candle right here. The day was November 20. They fell a little lower, looks like the same day, bounced off the 200-period moving average. That's not too surprising there. That's the black upsloping line. Not a surprise that the bulls would have defended that area. But what we're looking at now is the top of this breakdown candle, which is slightly above 675. call it 675.50 and some change. So when timing lines up and there are other signals that converge with this kind of bearish consolidation, you oftentimes will get some type of selling up here if price makes its way back up here, especially if the timing is right. And usually price is forced down from this area, maybe a little, maybe a lot. But what did they do in this case? They spiked the high of this breakdown candle on this day, closed below it, closed the day below it, and then the next morning price gapped above the high of this breakdown candle, above that 675.50 or so, and kept climbing. That was the signal that price was likely not going to get back down into the body of this candle, somewhere in this neighborhood, or certainly the low, at least anytime soon. And sure enough, after messing around a little bit for a while, they got up, came back down, retested this 675 area, got below it, and the bulls successfully held it, did not let price get below it, and that helped price stay above, and they've been mostly above the high of this breakdown candle ever since, until this last Friday at least. But the point is, that is not what we have been seeing on this 4-hour chart with these other bearish consolidation patterns. All the ones you see here for the past 5 weeks or so have eventually played out in the downward direction, and that is what you would expect. So this would mean price needs to get above and close 4-hour candles above each of these large breakdown candles in turn to negate the bearish pressure that each one of these have created. It can happen, but I hope you can see that it would take a lot of very bullish behavior, lots of buying in the market, overall market, for that to happen soon. Hopefully you understand the point I'm trying to make, which is that when you see a lot of signals show up on longer and longer time frames, starting like hourly, 2-hour, this is a 4-hour chart, and you start to see that kind of morph into the daily chart, and then the weekly chart, and longer, then that is something to take notice of. Right now, price is hanging on the edge of a cliff. That's the way I see it. The bulls can still defend this zone between 675 and 672. We'll just have to see what the bulls can do with it this week, starting tomorrow. That's Monday. Actually, it's today. I'm making this video after midnight, Sunday night. One other thing I want to spotlight is the DJT, the transports. You know how we called this trade up here at 20,000? We said the odds were good, that they'd get up there, they'd spike it, and pull back a decent amount. So that happened. And then what do you see here? Yes, this is another one of those bearish consolidation patterns. This one is more classic in the way that it formed for a couple reasons. One is that the daily candles after this big breakdown candle posted were all contained within the body of this large candle here. Price started to stair step its way back up toward the top, and when it got close, resistance was met, and price was pulled back. They started falling. That's pretty much by the book. The first time it happened here on Monday, February the 23rd, was the 7th day from the big breakdown candle that started it, back on the 12th, I guess. So 7 trading days, pretty important. Then there was another bearish consolidation starting with this down candle here, kind of with like a bearish consolidation within the bigger bearish consolidation. If they're going up, then on the 7th day, they pulled down quite a lot, but they recovered. Then it was the next day when the big move started. That's what's kind of cool about this whole consolidation. It was the 14th trading day. Price never got above the high of this thing. This is the 14th day, and that's when the bulls really started to give it up and let price fall. And now a couple days later, we have price well below the low of this breakdown candle. They closed below it. The timing for this whole thing was perfect. So there you go, another free lesson. You'll find that timing is often more important than price. In other words, it didn't really matter where price was over here on this 14th day of this consolidation. It was the timing aspect that you would have played for this thing to start falling from here and play out to the downside. There's a lot of points, a lot of dollars represented here. And to wrap this thing up, let me ask you one more question. If you've been paying attention, tell me, where would you know that you would be wrong about this trade if you were in a short position against the high of this breakdown candle, 20,000 give or take? The answer is your short position up here, entered on the 14th day, expecting price to fall, would be wrong if price got above the high of this candle, call it 20,100, 20,200 or so, closed 1, 2, or more days above that level, and after a couple daily closes, the smart thing to do will be to take the loss, close out the short position, because if that would have happened, the market will be telling you that higher prices are likely coming. But to bring all this together, the transports here can be a leading indicator to the SPY. And what do we see on this daily chart? At least one day that closed under the 50-period moving average. That's something we need to pay attention to. And the weekly chart is still bullish, but there will need to be some defense played by the bulls at the bottom of this break up candle. Call it 18,300 or so. And then farther down around 17,600 or so would be another area that the bulls would need to defend. And if you're wondering, yes, price can bounce from the low of this breakup candle. It's like the same thing as the other examples, except this one is a bull consolidation. There's probably more bearish momentum going on right now for this one, so it could be a challenge for the bulls to fight down here. We'll find out soon enough, though. And on the monthly chart, this March candle would need to close decisively under the February candle, which would be like around 18,200 or so, 100, for this to be a long-term reversal signal. We still have 3 weeks left in March, so there's no guarantee that will happen. It's just something to be aware of. If we do get a monthly reversal signal here in the transports, the timing would be pretty ripe for a bigger long-term pullback too. But all that is just to say that we need to keep an eye on the transports because it could be the first signal we get that the SPY might do the same. Maybe a couple days or a week or so later, but usually the DJT, the transports, lead the SPY in these kind of bigger moves. Okay, I didn't expect to spend so much time talking about big picture stuff. I hope that analysis and the chart reading lessons were helpful for you though. So what about our daily levels and the trades that we had for the week trading the E-mini futures against the SPY? Well, let's just jump right to the tracking log. Yes, it was a very good week. While the rest of the world was panicking and probably a lot of traders were losing money, we grabbed base hit after base hit all week long. If every level were traded each day and traded per the rules for Monday through Friday this past week, there was about 84 S&P points to be had to put in your pocket. That translates into a lot of dollars, depending on how many contracts you're able to trade. I would encourage you to visit the daily recaps page on my website if you want the behind the scenes of each of these days. It would be this page right here, the daily recaps. It's all there, posted each day after the market closes. You have the levels and the game plan for the morning, plus the analysis and recap after the market closes. So the entire week is here. If you want to go back and look at this, it's a continuous narrative arc. Each day has an effect on the next day. I hope you follow along and get some value from it. So back on the tracking log, I want to bring your attention to a couple things. The first is that so far in 2026, this trading approach has returned over 37%. That might seem like a lot to some people, already deep into double-digit returns, and we're barely into the third month of the year, but it is what it is. And previous years were already higher at this point than we are now. It's just the nature of how effective futures can be, trading futures. We don't try to nail the top or the bottom of any given move, and we don't try to stay in trades longer than what is most probable in terms of points. Some levels do provide home run trades where the bounce is 40 or 50 or more points, but this approach is all about letting the base hits pile up. That's what you see here, a handful of high probability trades each day, and there are only 4 ES points each. That's all it takes. The other thing I want to point out is that the win ratio has risen, as we said it would. We're slightly above 80% now. That can and probably will go down as time goes on. The long-term win rate is slightly below 79%. So I don't know about you, but getting that many days ending in the green is all I need. So keep an eye on that metric. I like it to stay above 75, but we just take what the market gives us. And it starts with the levels posted each morning. Check out the website to find out more about how we do things here if you're interested. But that's a wrap for this week. I hope you found some value in what we covered. And if you did, please consider subscribing to the channel and liking this video. I thank you in advance. Trade well this coming week, and I'll talk to you again soon.